What's up, everybody? My name is Andrew Filar, and I am one of the owners here at Next Call Club, but I'm also one of the owners and the CEO of Peachy Insurance, one of the largest Allstate agencies in the country. And so, what I'm going to do today is I'm going to pull back the curtain on how we pay our sales team. And so, people ask all the time, they say, how do you compensate your sales team? Do you do a low base, high commission? Do you do a high base, low commission, something in between? Well, today, all your questions will be answered. We're going to pull back the curtain. We're going to go through it in depth. And I'm not only going to go through what the comp plan is, but I'm going to talk a little bit about why we chose the mechanisms that we did. And so whether you are a producer who's looking to come work at Peachy Insurance or any other agency, and you want to see what our comp looks like and how it compares to what else is out there, or you're an agency owner trying to figure out if the way that you're paying your salespeople is in line with other agencies, or if you're just trying to get some new ideas or learn about how one agency, again, this is just my agency, compensates their salespeople in a sea of tons and tons of agencies that compensate their agents in different ways. And so hopefully today you walk away from this understanding exactly why we built the compensation like we did, how it's profitable for everybody, and come away with one or two ideas that you can implement for yourself. And then again, if you are a producer and you like what you see, we are always hiring talented people who want to work hard, who want to grow. Just look in the show notes. There's applications or a link to our application below. Let's dive in. All right, everybody, here we are. It is the 2026 compensation plan for our outbound sales role. Now, before we dive in, one of the things I want to just kind of point out really quickly is if you found us on YouTube and you want to get your hands on this compensation plan, just look in the notes of the video. We have a link to where you can go download it and have access to it so you can see it yourself. The other thing I want to point out is that it says Georgia Sales Compensation 2026. Okay, so one of the nuances here is that we have agencies in 2 states, but we cover 5 states that we can write in because of our locations on a border. So we have a central team, which is Tennessee, Arkansas, and Mississippi. And then we have the Georgia team, which is Georgia and Alabama. Right now, the premiums are relatively comparable. And so the comp plans are the same. But we always like to keep them slightly separate because they are different teams. There is a little bit of overlap for redundancy purposes. But for the most part, Georgia sells in Georgia, Alabama. Central sells in Tennessee, Arkansas, and Mississippi. For right now in 2026, the comp plans are 100% the same. Just wanted to point out that slight nuance. Okay. The other thing I would say is that one of our goals here for our salespeople, especially on the outbound side, is to make 6 figures and to do so by, definitely in their second year, but ideally in their first year as well. Granted, in the first year, there is a little bit of ramp up, right? You come in, you got to go through training, you got to go through binding authority, all of those different types of things. Doesn't matter if you are an Allstate agent, a State Farm agent, a farmer's agent, there's going to be corporate trainings. And even if you're an independent agent, there's going to be a learning curve. And so the first couple of months, you might not be on track for a full 6-figure earning type year. However, after 4, maybe 5 months, from that point on an annualized basis, we expect our salespeople to be making 6 figures, if not $140,000, $150,000, $175,000. And what we're going to do is tell you exactly how that happens by going through this comp plan. The other thing that we're going to do is we're going to show you kind of the why behind how we chose all of these types of things. And the other thing I'll just say as like kind of 2 last pieces here. Question that always comes up is, are you in office or are you remote? We are a fully remote agency. We have a very, very minor in-office presence. So there's somebody there to answer the door if a customer comes in. Other than that, these are salespeople working from home. We do not rely on walk-in sales. Yes, we get call-ins, but a lot of our process is done by calling internet leads, making outbound calls on requotes, X-dates, winbacks. We do bring some calls in. Yes, we send some mail, but we are largely an outbound agency that works from home. The second thing I would tell people is that we might not pay as high of commission upside as other agencies. However, 2 things are true. 1, we pay higher salaries than other agencies, especially after 6 to 12 months if the production is there. And I'll show you that in a second. The other thing is that we offer a full benefits package. We offer health insurance, vision, dental, 401k, tons of time off, education reimbursements, sabbatical, all of these things. And so While the upside might be slightly higher at other agencies, we make up for that with benefits, higher base salaries, and overall stability. And the last thing I'll say here, which is I think something I'm the most proud of, and our sales leaders should be proud of too, because I certainly didn't make all of this. I didn't even make the 2026 comp plan. But what I'll tell you is that our comp plan has been structurally the same. And what I mean by that is that the salary upside and the bonus structure has been largely the same since 2018. We have barely changed this in the last 7 years. And so when we first opened the agency in 2028, I apologize. When we first opened the agency in 2018, Peter Godley, who runs our entire sales operations, our chief revenue officer, and I moved up to Georgia and started this from scratch. Structurally, this is the same comp plan with small tweaks in terms of entry point, salaries, production has changed over time to adjust for how premium has increased. So with that, let's go ahead and dive in, and we're going to go through this slightly backwards. And so what I mean by that is, like, I'm going to scroll down and I'm going to talk through our salary element first. Then I'm going to talk through how people get a monthly bonus. And then I'm going to talk through all of the extra ways that people can make money. All right. So let's do it. So let's start out with how we pay salary. Okay. So let's go down to the second page, and you are going to see this right here where it says sales compensation 2026. And this little note right here where it says ability to be reviewed quarterly. Okay. So we put this in here because our goals can change from the company every quarter. And so we almost never adjust this. Changing a salesperson's goals, especially mid-year, is very disruptive, and it typically leads to a lot of frustration. And so the less that you can change a salesperson's comp plan, the happier they're typically going to be. One of the questions that we asked our top producers, what are one of the great things about working here? We also asked, what are some of the rough things about working here so we can get better? But 2 of the 3 people have consistently said the same thing. They said, I blew the lid off the comp plan, and in other places that I've worked, they've moved the goalpost. They've made it harder. They said, oh, well, you're producing this. Well, now we're going to raise your goal and it's going to be harder. And they said, you guys didn't do that. And the reason that we don't do that is because if you design your comp plan properly, everybody wins. And what that means is that if you get to a place where somebody is producing twice as much as you thought they ever could, that you're not losing money on them. Everybody is winning. And so when you design a comp plan, we want to think about all of the ways that your comp plan can go wrong from a business perspective. You should be celebrating. You should be over the moon if somebody breaks records and blows the lid off your comp plan, because it means that you're making money and they're making money and everybody's happy. But so often people have a poorly designed comp plan to where somebody breaks through the lid and now that agent is losing money and they have to go change things and people feel like it's a gotcha. Don't do that. Okay. So let's dive in. Let's talk about tiering. So tiering is the secret sauce, I would say, of what makes our compensation plan unique compared to other agencies. And so people will sometimes come to me and say, what's the salary of like your top producer or top producers? And what we tell them is that it's anywhere between $85,000 to $100,000. You can see me hovering over it right here. And they say, that's crazy. Why would you do that? Like, how do you pay so much? Well, the reason is because of the way our tiering is set up. And so the way our tiering is set up is basically a 6-month non-recoverable draw. And now that can sound confusing. That can sound scary. I'm going to make it really simple for you, okay? What you do in your first 6 months of the year determines what your pay will be the next 6 months. And then that will determine what your pay is the next 6 months, so on and so forth. Every 6 months, we review what you produced and then re-tier your salary based on that. And so what we mean is that if you start in January and you go all the way through June and you average, call it 95,000 in annualized premium, because we annualize the auto here. This is not written. This is annualized premium. That means that if you average 95,000, you're going to be tier 3. That means your salary bumps from 45,000 to 65,000. That's assuming you are a brand new person. With that comes more risk to us as the agency. And so when we raise your salary, we want to be sure that somebody's not going to take that higher salary, pull off the gas, and coast. And so we share that risk in two ways. The first way that we share that risk is we say you have to now write 65,000 in premium to start earning a bonus. That doesn't mean your entry point is any lower. It just means that if you don't write 65,000, you do not qualify for a bonus. You still start earning on the same premium grid as you would have if you were at a $45,000 salary, but you just have to produce at a higher level consistently. Now, what I'll tell you is that if you're averaging 80,000 a month, hitting 65,000 should not be scary to you. Granted, we know that sometimes people are on vacation and we have PTO relief built in for that. So basically meaning if you take PTO, we are going to credit you your average premium that you normally get. Because what I don't want to happen is I don't want people to avoid going on vacation because they're afraid they're going to miss out on commission or they're going to miss their goal. And then they work too much, they burn out. That can happen. It happens all the time. It happened to me when I was a producer. I would never go on vacation because my base salary was so low that if I went on vacation, not only was I missing out on commissions, but I was also paying for that vacation. It essentially cost me double with the opportunity cost. So we want people to take rest. We want people to take time off because if they don't, they're going to burn out and leave or be miserable or not have a lot of fun or anything like that. So stick with me. So, okay. So that's the first mechanism is if you tier up in your 6 months, we share the risk by making your entry point higher. You have to now write a higher minimum than you did before to earn the bonus. Make sense? If not, leave me a comment and I'll clear it up. And that's good feedback for me. The second way that we share risk is that just like you can go from 45,000 to 65,000, you can fall back down from 65,000 to 55 or 45 if you do not continue to produce at that level. So the idea here is that if you earn your way up to tier 3 and get a 65K salary, or tier 4 and get a 75K salary, or tier 5 and get an 85K salary, our top producers are tier 5 and tier 6 because they are so consistent. But the idea is that if you get this big salary increase and then you pull off and you decide to start coasting, well, your salary can drop back down in 6 months. And what we'll tell you is that most of the time when somebody tiers up, I'd say like 90% of the time, they stay there or go even higher. And the reason for that is because if you are going to consistently write enough premium over a 6-month period to earn that salary raise, it means you have the right habits, you have the right systems, and that you're consistent enough to do that. And so the likelihood of you stopping that is very low. And so we've never really had somebody, I shouldn't say never really, we've never had somebody get a salary raise and then just give up. It just has not happened. And we have mechanisms to take care of that if it did, which I'll show you in the automatic PIP. But the point is that most people, 90% of people, tier up and then they try to tier up even higher. And because they've had the systems, the consistency to get there, they don't stumble, they don't fall. There have been times where people have tiered down. And that's always a hard discussion because sometimes somebody will tier up to tier 4, let's say, or tier 5. And they did it, like by the hair on their chin, right? They needed to average 120 and they averaged 122. And, maybe they had one month where they wrote 200,000 in premium and the other months were, 95, 100, and it pulled them up. So it is possible to drop back down, but it's on us as the leaders, it's on the sales managers to make sure they're having those conversations with salespeople. So this is our salary mechanism. Everybody comes in at $45,000 a year. In your first 6 months, we don't make you wait 6 months. We do after 3 months on the phone, we go ahead and retier you. So if you get off to a rocket hot start and you're writing 80,000 or 100,000 in premium those first 3 months, we'll tier you up after 3 months. We're not going to make you wait for 6 because if you've earned it, you've earned it. Okay. So that's the salary mechanism. Okay. And one of the things that people ask me all the time is they say, well, how do you track the premium? Is that based on like what you see in their tracker? Is that based on, the numbers you see? Nope. We look into the system of what's issued. So for us, we have a centralized system and I imagine every carrier does, but you go into the carrier system, what issued and what are we getting paid on? Because if it's not issuing and we're not getting paid on it, something went wrong. Either they left the company and came back too soon. Maybe they already have products with the company and it's not really new business. It's an ad car or an ad policy, something like that. But basically the idea here is if it shows up in our system as issued and paid, we pay the staff on it. We pay people the same way that we get paid. And by doing that, we align incentives and everybody wins. Okay, so that's the tiering mechanism. In the first 6 months, most people land in tier 2 or tier 3. Our goal for them is tier 3, and I'll talk about how we get there. Pretty straightforward, easy. I don't know if I'd say it's easy. It is simple though. And what I'll tell you is that the people who show up, take the coaching, take the training, buy into the daily goals and efforts are almost always hitting tier 2 or tier 3. If somebody's still tier 1 after 6 months, we're having a conversation with them about, are they putting enough work in? And do they need more training from us? How can we help them? Because I don't want anybody to have a 45K salary after 6 months. I want them to be at 55, 65, 85, 100 plus. Because at the end of the day, if they're doing that, the agency's making money and we all win. So as we come down here, I'll come back to the automatic PIP in a second, but let's actually talk about how people get paid on a bonus grid. And so right now, you'll see that when somebody hits 55,000 in premium, you can see where I'm hovering, they get a $1,000 bonus. So for us, we are at about, I don't know, 1,400, 1,460, something like that in premium per item on an annualized basis. This is the average, okay? So if we think about 55,000 divided by 1,460, somebody needs to write 37 items to earn a bonus. That would get them 55,000 in premium and a $1,000 bonus. Our goal for all of our salespeople is for them to write 63 items, which again, I will show you how they do that later in this call. But what you can see is that if somebody writes 55,000 in premium, they get a $1,000 bonus. They don't have to write 63 to earn money, but if they want to tier up, they want to make 6 figures, and we're doing our part to get them where we really want them to be. Over time, we want them over 60 items, and I'll show the math there. But what I know for a fact is that if somebody's writing 60 plus items, which is possible by just doing the daily activities, they're profitable, we're profitable, everybody's happy, everybody wins. So what you can see here is everybody starts earning $1,000 at 55,000, and then every 5K or so of premium, they're getting another $250. There are some break points in here. So you can see that at 70K, it jumps from 1,500 to 2,000. And the reason for that is that we want to incentivize people to be at 70K minimum. Again, 70K, if we just think about 70,000 divided by 1,460, that's 48 items. Somebody writing 48 items, we're really trying to push them here. And then you see another big jump at 80,000 to 2,750. At 2,750, 80K, they're sitting around 60 items. That is where we want them to live. If they're writing that type of business, they're tiering up to tier 3, they're making 6 figures. So as we showed you with the salary tiers down below, if you're tier 1, 45K base, you got to hit 55K to earn that bonus. But if you're tier 2, it's 60, tier 3, it's 65, tier 4, it's 75. So what happens if somebody's tier 4 and they write 75,000? How much money do they get paid? Well, I'll show you. At 75,000, they're going to get paid $2,250. You can see it right here. Their bonus doesn't start at 75K. That's what they need to earn. They still start earning 1,000 at 55. What happens if somebody who's tier 4, again, we'll show it again, needs 75K and they write 60,000 in premium? Well, 60,000 would normally get them $1,250, $1,250 that month. But because they did not hit their minimum, they don't get a bonus that month. So that is how they share risk. Every year, we adjust this up or down depending on premium. When we first started this, I think the entry point was 40,000. And so if you think about this 7 years later, we have increased that 35%. However, the average premium increase over that same time frame is 58%. So we've increased the goal 35%, and the premiums increased over 50%. So in theory, it has gotten easier to hit the goal from a premium perspective. So this is the main kind of meat and potatoes of our comp plan, is the salary tiering, which you find on the second page, and then the monthly PNC premium paying out bonus every single month. So let me kind of go into the stipulations here. When we bundle the auto, we annualize the premium. However, if it is a monoline, we do not annualize it. So some people don't pay on monoline at all, or they pay a lower percentage on monoline. We're just paying less on the monoline. Our goal is to bundle at 95%. And so all of these companies have these kind of crazy householding bundling type metrics. And the way that we look at it is if you write 10 households and 9 of them have 2 or more lines, that's a 90% bundle rate. If you have 5 that have 2 or more lines, that's a 50% bundle rate. We keep it relatively simple. And the auto does not need to be bundled with a home to unlock the annualized part. If it's an auto and a boat, we're happy with that. If it's an auto and a renter, we're happy with that. Obviously, we want to get the home and the auto or the auto and the renters every single time, but sometimes something doesn't qualify, or sometimes you get a home and a motorcycle or a home and a boat. The idea is that we never want to walk away with one policy if we can avoid it. However, another question comes up and says, well, if if you're not annualizing it, don't people just walk away from it? And so we talked about that with our team early, is that it actually just makes sense to go ahead and write business. You're better off, even though you're getting paid less on it, you're better off set what we call a future bundle opportunity, a follow up in the future to go get that other line. Okay. Here's the other thing too. Technically, maybe you hit 65,000 in premium, but you only wrote 32 items because you had some whales in there. This used to be a problem for us. We used to do everything based on premium. But we would find that some people were hitting 60, 70, 80,000 in premium and they'd have like 40 items. And the problem was that they were writing a bunch of high risk, kind of bad business. And like, I don't blame the producer for that. That's on me and on Peter and the leaders for marketing to those people in the first place. And so what we don't want to do is, like, we don't want anyone to feel discriminated against, but what we do want to make sure that we're doing is that we're going to low risk customers that are a good fit for our company's niche. And so if you're having all of these people living off whales where they're not getting a lot of sales, but they're like really big sales, that might work in the commercial insurance world. That might work if you're like in a high net worth property and casualty agency. That might work in B2B, but like in the home and auto B2C insurance agency environment, we need to have the item count or else the premium and the profitability falls apart. And so what we did is we instituted a minimum of 35 items. And so if somebody can't write 35 items in a month, even if they hit their premium goal, we're not going to pay them for 2 reasons. One, it means that they probably left a lot of opportunity on the table. 2, if they can't write 35 items in a month, they probably have a very low close rate and they need to share the risk that they're taking with us. And so, yes, it's on us to train them. It's on us to bring awareness to them. And we do a lot of training. Believe me, nobody wants somebody's close rate higher when it's low, the leaders at the company, but the producer has to want to do it too. It's easy to say, you know what, like, I'm just going to be the cheapest. And if that person's not cheap, I'll just make more calls or do more quotes. And the reality is, like, you don't want to polish a turd. If you're twice the price and somebody doesn't care about value, move on. But if you're $100 more every 6 months or per year, you can make that sale, but you actually have to sell it. And so the people who just focus on price close at a very low rate and burn through a lot of marketing that your better closers could probably take. So you want to have some type of minimum in place, whether it's around close rate, whether it's around items sold or something, to go ahead and make sure that they're not hitting the premium goal at the cost of your marketing. It is one of the biggest hidden costs in an agency. Okay. Now this one is a little bit controversial, right? I don't say controversial because, like, we get a lot of crap for it, but everybody does something different on chargebacks. When I was a producer, I used to get charged back for a full year, which meant it had to go through 2 renewals on an auto basis to win. And if you're in an environment where they're constantly raising rates, the chargebacks are going to be crazy. And so I wound up actually quitting my job as a producer in part because my chargebacks were so high. And it didn't matter, it's like I wasn't cutting corners. I wasn't doing anything shady. I was doing all my own service work, but people would get a rate increase after, second renewal in a row, and they'd be like, I'm going to go shop, and they'd leave and I'd get charged back. And so after a while of writing so much business, my chargebacks were so expensive. I was like, I'm working so hard just to basically replace my income. And in most agencies, you have a customer service team and like a retention team. And if something's being written poorly, there's a compliance team or something, right? There's mechanisms in place to solve this problem. Like, we don't want to write a bunch of business and just have it churn. It's a waste of time for everybody. But we want to make sure the producer isn't just getting crushed with chargeback. So we made the decision to go to 134 days. So basically what that means is if they're at 135 days or later and they get a rate increase, because we've taken a rate increase, a bunch of times in the last few years, just like every company all over the country. Everyone's dealing with this. Doesn't matter if you're Allstate Farm or State Farm Independent. People are dealing with rate increase. It's just a thing. I don't want the salesperson to be punished because the customer got a rate increase and decided to shop and quit. It happens. And that's not necessarily the salesperson's fault. So we do 134 days because if they can't even get them to that first renewal issuing, it probably means that they sold something where they didn't uncover that the person was going to sell the home or sell the car. It's not uncommon to see someone be like, oh, I need to get insurance on this home. And then 2 months later, they're selling it because they inherited the home. We probably shouldn't be writing that in the first place. We should be turning them to a 1-800 call center and saying, hey, call them. Because at the end of the day, it's not good business. The other thing is like if somebody buys something and then cancels a month later because they took another phone call and somebody gave them a better rate, they probably didn't do that good of a job selling it in the first place. So what we do is whatever the terminated premium is, we reduce their goal by that in that given month. So if somebody wrote 100,000 in premium and they had 15,000 of chargebacks, we lower their premium to 85,000 and they get a $3,000 bonus instead of a $4,000 bonus. We don't want to go back to that month and reduce it or do anything like that. We just reduce it from that individual month. And then the other thing that we do is we go through these terminations, we go through these chargebacks with the agents to try and get to a root if they're doing something wrong or if it's getting canceled from underwriting. How do we fix it on the front end so we can maximize the earnings for our salespeople? We want everybody to make as much money as possible because, again, if they do, we make money, everybody wins. So those are the two main components of our comp plan. So let's start getting into kind of like the other things, right? So I'll come to the quarterly bonus bucket, but let's go ahead and start with these other two. There's three things that kind of are on a month-to-month basis. So the first one's our monoline bonus. So we talked about this. It probably should be called a bundle bonus, but like we want to focus on being 10% or less of monoline, meaning I think I already gave the example. You sell 10 households, 9 of them need to have 2 or more lines. And that doesn't include little things like roadside or jewelry. Like we're talking like real policies, like real things. Not the jewelry and roadside are not real. They are real. But we're talking home, property, wheels, boats, like, those types of things. They carry significant premium. So basically what we're saying is if you write these households and less than 10% is monoline, we're going to just go ahead and give you an extra $500 bonus. Okay, but there's a caveat. You've got to write 60 items. And so that means if you're scraping by at 40 items, in your bundling or you're turning business away because you don't want to mess up your monoline bonus, you're probably not going to write enough items to get this bonus in the first place. I would say a majority of our salespeople are hitting this bonus every month. And when they're not, again, we're going through trying to get them on track. Now, the 60 items can feel daunting to a lot of people. And sometimes we'll talk to a producer in an interview and they'll be like, 60 items? Like, that's crazy. Like, I don't think that's possible. But what I'll tell you is that we provide a lot of resources here. And so this is important because if you're a producer listening to this, you have to understand that it takes both resources and work ethic. Well, I should say 3 things: work ethic, resources, and skill to hit goals. Okay. You can't just have work ethic and skill with no resources. You can't have resources and work ethic with no skill. You need all 3: work ethic, skills, and resources. And when all 3 of those things come together, good things happen. So what I'll tell you is like when we are here, we say, look, if you work hard and you take the training, you're going to have the resources, you're going to hit this goal. Okay. But if you're missing one of those 3 things, it won't be resources because we're going to provide those. It could be the work ethic or the skill, but we're going to help you with the skill. So work ethic is really what it comes down to. Now, when you are an agent, if you're an agent listening to this, don't look at this comp plan and say, well, you know what? Like Andrew and his team are expecting 60 items. That's what I'm expecting out of my team as well. And here's why I'll tell you that is because we tend to spend anywhere between $4,000 to $8,000 in marketing per month per producer. And so for the month of January, I think we're trending, I don't know, that's at the month of January 2026, when I'm recording this, we're trending 600 to 700 items, something in that range. Well, we're going to spend probably $60,000 on marketing this month. And so if you're an agent and you're writing 100 or 200 items a month and your average producer is doing 30 or 35 items a month, and you're like, wow, Andrew has his team at 60 on average, or he wants them at 60 on average, I need my team to get 60 on average. Well, also ask yourself if you're spending $4,000 to $8,000 in marketing per person. And if you are spending that type of money and you're still not getting your results, well, you maybe need to look at your marketing because maybe your marketing is not locked in, it's not targeted, it's not good. Or you need to look at the skill and effort of your team to make sure they can hit this goal. So I've kind of gone off on a little bit of an aside here, but I wanted to talk about this because I think that people can look at these numbers and it can be scary, but it comes down to, again, skill, resources, and work ethic. And if you're a producer, you can't control the resources you're given. You can control if you're resourceful, but you can't control the resources that you're given. You can control the practice and the skill, and you can control the work ethic that you have. If you're an agent, you need to make sure that the people you're bringing in have the work ethic that they need to be successful. And if you're in an outbound role and somebody's not going to call, well, you got to get rid of them or you got to move them to a different role. Because if you're buying leads or you're trying to do outbound and somebody won't dial, you're dead on arrival. If they don't have the skill, you need to train them or hire a trainer internally or externally to help them because they're not going to get better on their own. Almost nobody is going to get better on their own. There are people, but they're unicorns. Like they're unicorns and they usually go off to be entrepreneurs and they're not going to stick around anyways. So make sure you're giving them the resources. And if you're not spending money on marketing, then you need to lower your standards. If you are spending very little on marketing, I would not expect your producer to write more than 30 items a month, unless they're just like an absolute savage on social media, driving their own referrals. To which I would say to you and to that producer, if you are generating 60, 70, 80 items a month off social media, you could probably do this yourself. So if you're an agent hearing that and you have somebody who's doing this, make sure you're paying them and rewarding them for the effort they're putting out there to generate their own leads and the brand for themselves that they're using on your behalf. Okay. So let's go to the activity bonus. Let's talk about the 60 items because we're going to show you exactly how we get to 60 items. So when we talk about what it's like to work at Peachy Insurance, people ask me all the time, how many calls do you expect out of your people a day? How much talk time do you expect out of your people per day? And the answer is that we don't really look at it a whole lot. We do track it, but I don't get on somebody if they don't have 100 plus calls. I don't get on somebody if they don't have over 5 hours of talk time. What we care about more than anything else is, did they quote 15 policies and are they closing at 20%? So 15 policies is not 15 households. It usually is anywhere between 5 to 8 households. And if you quote the home and the auto together every time, on 8 households, you have 16 quotes on the day. So what we tell people is if you quote 3 lines per household, which we're very much trying to do, right? Because we want to get the boats, the landlords, the umbrellas, the golf carts, the ATVs, the snow machines, all of it. If you quote 3 lines on every policy, you only got to do 5 households. If you quote 2 lines on every household, well, you got to do 8 households. And if you quote 1, you got to do 15 households. If you're quoting 1, we're never going to let that happen because we're going to be training you nonstop. Quoting 2 is great. Quoting 3 is better. And so if you do 15 quotes a day and you close at 20%, okay? So again, let me pause here for a second. When we say close rate, we're looking at item close. We are taking items sold divided by policies quoted. So let's just kind of do this math and I'll see if we can get it up on the screen to the side. If you have 15 quotes times 21 days, we end up with 315 quotes in a month. And if you close at a 20% item basis, you take 315 multiplied by 20% and you get 63 items. So what we're basically saying in this comp plan is that if you write 63 items because you did 15 quotes a day and closed at 20%, you get a $500 bonus just by hitting the kind of the basic expectations. And we don't, at that point, we don't care about calls or talk time. Now, if somebody's doing 15 quotes a day and they're not closing at 20%, we're going to dig into why. Is it a skill issue? Are the calls very short? You know, what is going on so we can get you where you need to be? But this minimum 60 items, it's kind of a facade, because if you do 15 quotes and 20%, you are going to have 63 items. So this almost doesn't even need to be in here, but we just put it here just as an example. And the reality is if you're doing 15 quotes a day and closing at 20%, you're almost guaranteed to close your monoline is less than 10% of your total mix. Almost guaranteed. It is very, very rare that somebody's doing this and then missing this bonus because their monoline was 15%. Almost never happens. Just the way the math works is like in order to close at 20%, you have to bundle. You just have to. Now, this is a new thing, this haircut. So if somebody is closing at less than 13%, we cut their bonus by 10%, which I think is very little. It's very small. The reality is if somebody's closing less than 13%, it's on us as leaders, it's on us as managers to get them on track. And if somebody cannot close over 13%, that's a problem. But I think if one of the things I just want to talk about, that minimum 35 items we talked about earlier, if you close at 13% and do 15 quotes a day, just I've done this math in my head, you're at like 43 items. And so when we think about our minimums, they are truly minimums, but we want our team at 60 items plus, because when they're at 60 items plus, they're getting tier 3, which is a 65K salary or higher, right? Because maybe they're writing more, and they're getting an extra $1,000 a month on their monoline and their activity bonus. So that's $1,000 right there. Plus, if they're writing 63 items, they're around 85, 90K. That's another 3,000 to 3,200 a month. You're talking about a 65K base and a $3,500 to $5,000 salary or bonus every month. You can see how we start getting to $110,000, $120,000 per year. And so these two things right here, monoline and activity bonuses, like these are just us saying, if you just hit the standards that we're holding ourselves to for this agency, you get an extra $1,000. So we do this because it makes sense for us. The reason it makes sense for us from a monoline perspective, well, on average, new business for bundled business at Allstate, who we represent, we get paid 25% new business. Renewals are a lot lower than other companies, but 25% on new business, which is really great because it allows us to grow quickly. But if we write monoline business, it could be like on average 12 to 15%. And so that extra 10% on one or two households more than pays for the $500 on the monoline bonus. Activity bonus, same thing. Just to kind of put this in perspective for you, if somebody's closing at 13% versus 20%, the average amount of difference for us in revenue is about $4,000 per month. And so it used to just be that we said, guys, you need to get 20% close rate. You just need to be there. We're going to coach you to it. But we said, you know what? Let's share some of this money and then reinvest the rest of it back into marketing that's better marketing for them. So the reality here is this, is that everything we do here has to make sense for us dollar-wise. But like really, like literally, like we talked about 13% being 42 items, and we talked about 20% close being 63 items. Well, that's a 21 item difference. And at, call it 1,000 in written premium, just to be safe, we're talking 21,000 times 25% new business. It's actually $5,000. And so you can see why this makes sense from a monetary standpoint. Okay. So just kind of keep that in mind. Okay. The last kind of monthly thing is this referral bonus. So last year was all about building the habit for us. We wanted to build the habit of getting people to ask for referrals. And so what we did was we put a bonus in place that was $250 every single month. And what we would do is we would listen to every closing call you had, not every sales call, but every time you took payment to bind something, we'd listen to that call and we basically asked the producer to tell us when they asked for a referral. We'd go to that timestamp and we'd see it. And if they did that on 90% of their calls, we gave them an automatic $250. That worked great at the beginning. It started building the habit. But over kind of the end of the year, we saw that our results on referrals were kind of dropped. Like we were asking, we weren't really getting the results. And so now that the habit had been built, we decided to go back to the drawing board and say, look, what should we actually pay people on the referral? And instead of doing it on the activity, we decided to do it on the result. And, you know, I think in general, I'm a big believer of paying on the result, not the activity, because when you pay on the activity, you get people kind of going through the motions. And I'm not saying that it's malicious. I'm not saying that they were being lazy, right? But like, we know how it goes. Like you do something, it's like a routine. You kind of do it every day. Like you're not as conscious of it. You drive to and from the grocery store. You've done it 100 times. You don't even think about it. Like you don't even remember it. So it's the same idea here. I do think there's an exception of rewarding people on the activity over the course of 3, 6, maybe even 12 months to build the habit, and then you move into it. So now what we do is we pay them on the sold household themselves. Okay. So we do not pay if it's a real estate agent or if it's a lender or if it's from another agency across the country who refers people to us. We don't pay a referral bonus on that. What we pay the referral bonus on is that we still want our salespeople asking for referral on every call they close. And we basically say, who do you know that we can reach out to? And if they won't give us a name or number, we say, look, if we send you some information, would you give it to them and have them call us? And people say, of course I will. And if they're not willing to refer you, I mean, it's kind of crazy. They just bought from you. So they, in theory, should be able to refer you. And if they won't refer you, well, that's kind of a red flag in and of itself. But the reason that we're paying $100 per bundled household, one, is because again, we don't get paid as much on monoline and we don't really want it. We'll take it, but we don't really want to incentivize that. But we pay $100 for every bundle referral household sold because on average, it costs us from a marketing basis about $250 to get a sale. So we buy a bunch of leads, we buy inbound calls, we do Google ads, Facebook ads, we're starting mail, and like on average, it costs us $250, $300 to buy a household, basically from a marketing perspective. And so in this case, we say, all right, if somebody gets a referral household closed, we're going to give them $100. And what I would say is that if somebody really blows it out and gets 8, 9, 10, something like that, and they want to negotiate more, we can talk about it, right? Like, because at the end of the day, if I have to pay $250 to get it from marketing, I'd rather pay $100 to my producer to get it themselves. Ideally, it's a stickier client because they've been referred. There's a little bit of a better relationship. We've also just kind of seen from internal data that referrals tend to have better limits and better credit scores. Like, maybe the sample's too small, but that's what we see in our market as well. So, keep that in mind as you're kind of putting these comp plans together or as you're thinking about this. So, we're almost through it. We do have Allstate Life and Retirement here. That's what ALR is. And basically what this means is that if somebody writes a life policy or it gets sold by an EFS, we're going to put 100% of that premium to their kind of monthly goal over here. So if somebody gets a life policy and it's $5,000 in premium, they're basically going to get paid $250 on it, right? Because it's going to bring them from 155 to 160, et cetera. And if EFS writes it, we do that too, because at the end of the day, the commission kind of works out. And even if we're going to lose probably a little bit of money if the EFS writes it, but it's good to do for the household. It's important to our goals. It's all your district and corporate leader will talk to you about is life insurance, even though like everything we get paid on is everything else. But like, it always comes back to life insurance. So we have it on the comp plan. Same thing with annuities and mutual funds, right? And this is just tied to how we get commissioned is that, if an annuity is a $100,000 annuity, the commission is probably 4% of that. And so that's the premium we add to the comp plan. Okay. So that's there. So let's talk a little bit about kind of the quarterly and the year end stuff. So here's quarterly. Okay. So we wanted a way to incentivize people for doing kind of like the small little things that are kind of out of the norm. One, because people say, well, I get paid on it. And second, so we wanted to kind of preempt that. Second, we also just to kind of incentivize people to do kind of these small things. And so we decided that 5 or 15 or $20 here or there, like probably wasn't enough to move the needle on a monthly basis. And so we decided to come up with a quarterly bucket for doing some of the small things right that over, a quarter could become several $100s or even, over $1,000. And so what are those things? Well, we give $5 for every SPP. So if you write a home policy and you include an SPP, now referred to as VIP, but basically it's scheduling jewelry, rugs, guns, valuable things. We pay an extra $5 for that. And the reason that we do that is because we believe that adding these scheduled items makes the home retention stickier. It makes people stick around longer. And I kind of came to that assessment. I was talking to my sister and she was like, oh, I think we have Liberty Mutual. And then my brother-in-law came in and he said, yeah, we've been with them for like 20 years. And I said, dude, you're probably overpaying, man. Like 20 years with the same company. Like I'm all about loyalty, but like we crush Liberty Mutual left and right. And he said to me, he goes, yeah, you're probably right. But honestly, like we have all of our jewelry scheduled on it and our appraisals are all out of date and it's just a big pain to go get it changed. And I was like, Ding. And so I went back and looked at our own data, and what I saw was that when we attach SPP or VIP, basically scheduled jewelry, our close rate on home insurance triples. That's not an exaggeration. It is literally 3 times as high. The other thing we found is that retention is about 4 points higher. And so I, in theory, should pay more for SPP and might actually go back and do that. But SPP becomes a really valuable thing. I think the reason that we only pay $5 is because we don't get paid a lot on it on the front end. And the data that we looked at is a small sample. So we're not necessarily confident that these things are true. But as we go back, I should probably look at the data. And if those things are true, we should probably pay more for it to incentivize people even more. The next one is landlord, flood, and umbrella. When people are basically getting these, it's almost always a third line. And so a landlord for us, it's property, which is great, and it retains like property, aka very well. Our average premium on a landlord is like $1,400 or $1,500 a year, and our close rate's 35%. And so it is literally 1 out of 3 get closed. And so what we do is we incentivize people to write them. We say, look, we want you to ask people, do you own a rental property on every single call they're on? Because you're going to stumble into 30, 40, or 50 of them a month. It's good business. It works well. It counts towards their premium, but they get an extra $15. Same thing with flood. Flood is an amazing, amazing policy. I'm from Florida originally. I know so many people who've gotten flooded and they were not in a flood zone. It is devastating. It is devastating. And a lot of people just assume their homeowners pays for it. They don't. Write the flood insurance. It takes a second. And then umbrella, same thing, $15. It helps people get through bad claim situations. It helps you write higher limits, extra $15. Okay. Then we have NatGen and Northlight. We don't get paid hardly anything on these. NatGen is a stupid low commission, but sometimes it's better to get something or get that person a policy. So we pay $20 per auto on it. So if somebody writes a 3-car NatGen, they get $60. Northlight, same idea. This is kind of a relic from the past. We don't put a lot on Northlight anymore, but the reason that we don't pay a lot on it is because it is a huge pain to service. And so if somebody really needs it or really wants to write it, it's there, but we try to keep it kind of low on purpose so people don't spend too much time on it. Now, you can see the SPL type of stuff, right? So just if you're an Allstate agent, you know what that means. But if you're not an Allstate agent, it basically means it's like, what are all the products that we sell that are not commercial and are not home and auto? And it's what's called SPL. And so something that we've been doing for the last several years is how do we get 3-line, 4-line bundles more often? And so this is the way that we've been doing it is we've been doing a ton of training on it, and we've been doing incentives in our comp plan. And so basically, if somebody writes a 3-line household, they get an extra $25. And if they write a 4-line, they get an extra $40. But that also can be a double dip. So if somebody writes a 3-line household, right? So they write a home, auto, and landlord, they get the $25 here and the $15 here. If they write a home, auto, flood, landlord, they get 40 here, 15 on the landlord, 15 on the flood. So these stack. And so there is a big incentive to write 3rd and 4th lines. Like if I were the producer in this case, I would be asking about flood and landlord every single time. They carry high premium, which pushes towards your monthly bonus. Plus you're stacking up the $25 or $40 plus the 15 and the 15. It is a cheat code. If somebody can do this, they are going to be stacking an extra couple $1,000s per year by just simply asking, do you have a rental property? And then at the end being like, hey, I looked it up. You're in a flood zone, or hey, you're not in a flood zone, but your elevation is this. And look, tell a story about flood. We have one of the people on our team had 2 inches of standing water in her house, was not in a flood zone, $80,000 in damage. She had flood insurance. So keep that in mind. Okay, so this is the quarterly bucket. People will sometimes say, oh, isn't this a pain to track? Yes, it is. Yes, it is, but it doesn't mean it's a reason not to do it, okay? Generally speaking, when we build a comp plan, we can have a great idea, but if we can't track it well, sometimes we'll scrap it. In this case, it's not super hard to track. It's a little bit tedious, but we have analysts on staff and we have VAs who can do some of this Excel work as needed. So, okay, so this is the yearly bonus here. It's called VC Vanquisher, but it's a yearly bonus. And basically what we've done is we used to do this all on premium, but premium changes every year, blah, blah, blah. So we basically said, look, let's just go to items. So if somebody writes 900 items in a year, they can take a $1,500 cash bonus or a $2,000 trip. I'd prefer people to take the trip, take some time off, get a cool experience, but a lot of people just prefer the cash. Basically, 900 items a month is 75 items on average. So somebody averages 75 items a month for me. I think this is worth a nice little small year-end bonus. Somebody does 1,000 items a month or 1,000 items a year, $3,500 or a $4,000 trip. And then 1,200 items, same thing, $5,000 bonus or a $7,500 trip. We had one person hit this and two people hit this. It's great. I've played with this idea of, being in a remote environment. Should we do like a big company trip or should we do like an award trip? And I think the reality is that most people would just probably prefer to go on vacation with their family or their friends, and so we can just give them the money that we would spend anyways and just let them make a choice instead of forcing them to go on this event. Do I think an experience is more memorable and more valuable long term? I do. But at the end of the day, like, who am I to decide what the best use of that money is, right? So we give them the choice and we basically say, look, we'll give you more money for a trip, or you can take a cash equivalent, which is going to be a little bit lower. So this is the comp plan, okay? So we went over the salary tiers, how people can earn a 65, 85, 100K base. We went over how they earn bonus every month. We went over their quarterly bonus bucket, right? The extra things. We went over their yearly goal. They have these stretch goals. It's awesome when somebody writes, 1,000 items or breaks $1 million in premium. Like, these are huge moments. We talked about the monoline bonus, right? How do we incentivize people to go bundling? And then we talked about activity. Just do the right thing every day. 15 quotes, 20% close. Like, you're going to make the money, right? And so, like, I'll just take this as a moment to say it. If you write 63 items a month because you did 15 quotes a day. Let me rephrase this. Let me say it a different way. If you are a salesperson here at Peachy Insurance and you do the 15 quotes a day that we ask you to do, that we give you leads for and live transfers for all day, and you close at 20%, which is about our average, okay? Like, we have people in the 30s, but 15 quotes a day and close at the average of 20%, you will write 63 items. If you write 63 items, you're going to be tier 3. At least tier 3, if not closer to tier 4, but tier 3, that's a 65K salary. And then just by writing the 63 items, you're going to make another $3,200 per month. Annualize that out, that's $45,000 in commission. You're at $110,000 a year. And then if you get the monoline bonus and the activity bonus as well, now you're looking at $121,000 a year. So think about that. Okay. Like, whether you're a producer thinking about like how to make money, or whether you are an agent trying to say, like, what is like the value prop that I have for other people coming to work for me? If they just do the daily activities, what are they going to make? This is called on target earnings. On target earnings for us on target is about 110 grand. Okay. So keep that in mind. So let's go to the last part of this. And this is what's called the automatic PIP threshold. Okay. And you'll see some stuff down here, which is like how people get access to the best leads. Just like a quick blurb here is new people, we put them on stuff that's like 5 or 6 days old. And the reason 5 or 6 days old plus requotes, the reason that we do that is because they don't have the skill yet to close at a high rate. And so we don't want to take our best leads away from our best producers. So we put them on stuff that's 5 or 6 days old, and they have to write 5 bundled households, and they have to do all of these things. It's not hard. There's a lot of value. People will work 30, 40, 50-day-old leads, and they're still writing 30, 40 items, right? So it's really not that much of a handicap, but it gives them a safe place to fail. The other thing is we have elite. So we have elite marketing, which is like if somebody's writing over 80,000 and they're bundling, closing, activities good, we'll give them our best leads. This could be mail, call-ins. They get first shot at cross-sells, the best leads, etc. And people sometimes be like, oh, like, well, if they're already good and they're getting the best stuff, like, aren't they like getting an advantage? Yeah, they are. And that's the point. The point is I want people to do really well so they get into the best leads and then stay there forever. So that's kind of the incentive there. And then the other thing too is that we have a telemarketing team. So until you sell 40,000 on new leads, we don't give you transfers. A lot of times people get an overflow. So if we have nobody to take it, the new person can take it, and then we expect the manager to score their call and coach them on it. So just wanted to kind of talk about that there. You see their daily activity minimums, 15 quotes. The talk time is kind of a safety measure, but we also don't want those 15 quotes to come from taking transfers. We want them to ask for referrals, make some dials, etc. Here's the PTO bonus relief we talked about, $2K in premium for each scheduled day of PTO. with a maximum of 5 a month. So if they take 5 days off, we're just going to credit them 10,000 in premium that month. So let's talk about the last piece of this, which is the automatic PIP threshold. All right. If you write below 35 items or 50K in premium on new leads, you're automatically on a PIP. If you write below 55,000 2 months in a row, you're automatically on a PIP, because if you remember, 55,000 is like 37 items. That means that you're probably doing a lot of work, burning a lot of marketing. If you don't hit a bonus back to back, you go on a PIP. 2 or more compliance stinks. We had to put people on compliance PIPs, right? Like, it's not like we take compliance extremely seriously. We have new business concerns. So what this is, it's just an anonymous form that our service team can fill out to say, hey, we saw something on new business that looks really off, whether it's malicious or not, we don't know, but it looks off. So if somebody has more than 2 in a month, that can trigger a PIP. And then basically, if they're not hitting 13 quotes a day, or they're not hitting 90 on activity score, they're going to be on a PIP, because at the end of the day, if you're not hitting 13 quotes a day on average, your work ethic's not good enough for us to allow you to be here. We have standards to uphold. And so what a PIP really is it's not an excuse to fire somebody. Truly, it's not. If I have somebody on the team that we've spent thousands of dollars to hire, thousands of dollars to pay while we've trained them, tons of time from our managers, tons of marketing investment, right? Like, we could be 30, 40, $50,000 in invested in somebody in the first 4 or 5 months. We want them to succeed. But sometimes it takes a performance plan to get somebody to wake up and really take it seriously. I can say to you all day long, gotta get your quotes up, gotta get your quotes up. But if nothing changes, nothing changes. And so a PIP is there to basically say, hey, we have a 30-day PIP. We want you to be here. We want you to be successful. And I know that there can be a lack of trust between like workers and management. And each person has to delineate and decide whether that person is authentic or not. But I can just tell you, when we put somebody on a PIP, we want them to be here, because at the end of the day, everywhere that we hire is an at-will state, which means that we can fire somebody at any time for any reason. So if we really wanted somebody gone, we would just fire them. And that happens if somebody's toxic, or if they're doing something blatantly non-compliant or not acting with integrity. There are cases where we'll just do that. Like, we have non-negotiables. But if somebody's struggling, we want to help them get on track. We can help somebody who's trying and failing. We can't help somebody who's not trying. And so sometimes the PIP is about getting them extra resources so we can get their skill up. Sometimes they have the skill, but they're not trying. And it's about getting them to wake up saying, hey, you need to start trying, or you're not going to be here. And so when we do a PIP, we talk about 3 things. Here's what we want from you. The second thing is, what do you want from us? Do you want more training? Do you want us to help you? Do you want us to do like any underwriting stuff? Do you want us to manage? Like, what is it for this next? We'll do it. And then third, what are new habits that we're going to establish so we're not on a PIP again? Because if you end up on a PIP 2 times in 12 months, it's automatic termination. So with that, we have just walked through the 2026 comp plan at Peachy Insurance. And so again, if you're an agent and you're still here, thank you for listening. Feel free to comment. Feel free to email me, ask me questions. Happy to help in any way. If you're a producer, you liked what you saw, you like the way that we manage, we're always hiring great people. So reach out. And if you have any questions, we're always here for you. I hope you got value out of this. Thanks.